Category Newsflash Format 3 Act What Happened / Why It Matters The Takeaway Target Length CN Puckert Hooker 3 Act What Happened Words Sure.
Here is a number that should stop you cold. $9.5 billion. That is how much Toyota, the most profitable automaker in the world, expects to lose this fiscal year to a single U.S. trade policy. Not to a recession, not to a product failure, not to a factory fire, to a tariff.
Toyota's CFO Kenta Kon confirmed it in earnings last week. The company has absorbed approximately 10 trillion yen in tariff-related costs for the fiscal year ending March nuko 10 niri luk 10, that is Q10 wodor luk 10 billion, give or take the dollar-yen exchange rate on any given Tuesday.
For context, that is more than the entire annual revenue of most Fortune 500 companies. And Toyota is one of 3 Japanese automakers writing numbers like that right now.
This week, Japan reported its 5th consecutive fiscal year trade deficit, 10 trillion yen, or roughly $10 billion, the 5th in a row, for a country that built its post-war economic identity almost entirely on export manufacturing. That streak is not a data point, it is a structural shift.
Japan's exports to the United States fell 10% for the fiscal year. Auto shipments specifically dropped 10%. Let that sink in. Japan's single most important export product, the cars and trucks that built Nagoya, fueled Toyota City and put the word Kaizen into MBA textbooks, is shrinking in America, the world's second largest auto market.
Here is how we got here. In July, Nissan, the United States and Japan announced a bilateral trade framework agreement. The headline number was a 15% tariff on Japanese auto imports, reduced from the initial 25% proposal that Trump had threatened, but still a massive step up from the near-zero rates that had governed the relationship for decades. According to Congressional Research Service analysis, Japan committed in exchange to increase purchases of U.S. agricultural goods, aircraft and energy, and to direct 600 billion in strategic investment into American industries by Nissan Q10.
The deal was sold as a win for both sides. For Japan's automakers, the reality has been closer to a controlled demolition.
Let's go company by company because the numbers at each one are jarring. Toyota. Toyota is the largest auto company in the world by volume. In fiscal Nissan ni luk, the company expected to earn around 9 trillion yen in operating profit. Instead, the combination of the 15% tariff and a weakening dollar, Japanese exports earn yen but get paid in dollars, has shaved that down dramatically. Profits are expected to fall roughly 30% year on year.
That single quarter snapshot from Automotive News says it most vividly in one 3-month period. Tariffs cut Toyota's profit by 91%, a $10 billion hit in a single quarter.
CFO Kenta Kon said the quiet part out loud in an analyst call. Toyota has been increasingly moving production to the markets where its vehicles are sold, specifically to hedge against exactly this kind of policy risk. In other words, Japan's largest company is quietly preparing for a world where it builds fewer cars at home.
Honda cut its full-year operating profit forecast by near 1%, from 700 billion yen down to 550 billion yen, or about 40 billion. That followed a second quarter operating profit drop of nearly 1%.
More significantly, Honda made an announcement about production that tells you everything about the new geography of global auto manufacturing. The next-generation Civic Hybrid, a vehicle Honda currently builds in Mexico, will be relocated to Indiana. The move is specifically designed to avoid tariff exposure. Production starts in Nissan Nihardi.
That is a company voting with its factories. When you relocate a production line across a continent because of a trade policy, that policy has won the argument.
Nissan is in a different category entirely. This is not managed decline. This is a crisis. Nissan's operating profit collapsed, -8% to just $76 million for its latest fiscal year. The company posted a net loss of $55 It announced the closure of 7 of its 7 global factories. It is cutting 1 jobs worldwide.
To understand what that means, Nissan employs about 110 people globally. 20,000 jobs is roughly 1 in 7. 7 factories out of 17 is closing 30% of your global production footprint.
The company also moved rogue manufacturing to Tennessee and is in active discussions with Honda about producing pickup trucks at underutilized U.S. plants, a collaborative arrangement between competitors that would have been almost unthinkable 5 years ago.
Nissan was already fragile going into the tariff shock, weakened by years of strategic drift after the Carlos Ghosn scandal and the slow collapse of the Renault-Nissan alliance. The tariffs did not create Nissan's problem, but they turned a difficult turnaround into an existential reckoning.
The sector-wide picture. This is not just 3 companies having a bad year. According to data from Nation Thailand's business reporting, 7 major Japanese automakers collectively lost 10 trillion yen in revenue in just the first half of fiscal Nissan Nichir Niten. The combined sector-wide profit cut for fiscal Nissan Nichir Look is projected at 10 trillion yen.
The Japanese government's own estimate puts potential annual auto sector losses at 7 billion. That is a tax in economic terms on a single industry. An industry that employs hundreds of thousands of people in Japan and underpins a vast network of Tier 1 and Tier 2 suppliers that form the backbone of Japan's manufacturing economy.
Here is the paradox at the heart of this crisis. Japan's auto industry did not fail. It did not make bad products. Toyota still has the highest quality ratings of any mass-market automaker. Honda's vehicles still sell. Even Nissan in its battered state moved 10 million cars last year.
What happened is that Japan's auto strategy, built on meticulous engineering, disciplined production, and global export, collided with a trade policy architecture that no longer rewards that model.
As we explored in episode sure, Japan's hybrid-centric approach was the right bet for much of the last decade. Hybrids are cleaner than pure ICE vehicles, more reliable than early-generation EVs, and cheaper to produce than full battery electric vehicles. For markets in Southeast Asia, the Middle East, and Latin America, hybrids remain the practical choice.
But the 2 largest auto markets on Earth, the United States and China, are both now explicitly rewarding pure EVs. U.S. Inflation Reduction Act incentives favor domestically assembled battery electric vehicles. China's market has been functionally closed to Japanese brands for reasons we covered in episode Noniji on rare earth supply chains. And in Europe, the emissions trajectory points directly at full electrification.
Japan built the world's finest hybrid supply chain. And now the policy environment in key markets has pivoted around it.
The tariffs are accelerating this stress fracture, but they did not create it. What does Japan do now? The short answer is it builds in America. Toyota, Honda, and Nissan are all accelerating U.S. production investments, not because American manufacturing is cheaper, but because the tariff math has changed the calculus. A car built in Indiana does not pay a 15% import duty. A car built in Toyota City does.
That is a subtle but enormous transformation. For decades, the Japan model meant engineer in Japan, manufacture in Japan, export globally. What is emerging now is engineer in Japan, manufacture where you sell.
For Japan's domestic economy, the implications are significant. The auto sector is one of Japan's largest employers. As production migrates to the United States, those jobs do not necessarily disappear overnight. Suppliers follow manufacturers, and R&D tends to stay close to engineering centers. But the trend line is not encouraging.
Japan's finance ministry reported this week that the fifth consecutive trade deficit reflects not just tariff shocks but a structural shift in where Japanese companies create value. When Toyota builds a Camry in Georgetown, Kentucky, which it has done since Senchu Hakazip Hatch, Japan earns from Toyota's profits, not from Japan's exports. Those are different numbers on different lines of a national accounts table.
The Japanese government is watching this carefully. BOJ policy is now complicated by the dual pressure of a weakening export sector and continuing domestic wage growth. The Shunto wage negotiations this spring produced a third consecutive year of approximately 5% wage increases, the kind of number Japan had not seen since the 1990s. Rising domestic wages with declining export revenue is a delicate combination for a central bank trying to normalize interest rates.
None of this resolves quickly. Trade policy moves on political timelines. Factory relocations take years. EV transition takes a decade.
But the week that Japan posted its fifth consecutive trade deficit, while Toyota absorbed billion in tariff costs and Nissan announced its 1,000th layoff, marks a clear inflection point.
Japan's auto industry is not dying, it is relocating, and that distinction between an industry that collapses and one that restructures across borders is exactly the kind of nuance that gets lost in the headlines.
That is what we are here to unpack. I'm host. This is the Japan Factor. If this was useful, subscribe. We publish daily analysis on Japanese business, economy, and corporate strategy for a global audience. See you tomorrow. Sen yu kakun nuaj, words estimated runtime, jur minutes at fakun worst WPM.